Alright everyone, Cowboy Trades here, welcome back to the channel. So we just had the US CPI come in hotter than expected for both headline and core inflation. So what we're going to do is we're going to talk about this new economic data, talk about how this is going to affect the cryptocurrency markets, Bitcoin, the equity markets, and wrap up on the bond market. So let's start off with the economic data, then we'll move into the Bitcoin market. So starting off with US headline CPI year over year, this was previously coming in at 6.5% and it dropped down to 6.4% in January. Now, why this is bearish is the consensus was predicting that we were going to come down to 6.2% and have a monumental drop from the last reading. Like I previously discussed in my last video discussing inflation, the revised CPI quite recently came out and it turns out inflation was hotter than expected, and they've also readjusted how the basket is measured. For example, energy has a higher weighting, and subsequently it seems like consensus was wrong on this one because energy prices are up and inflation came in hotter than expected at 6.4% rather than 6.2%. A higher than consensus reading is always bearish for the market, so this is why the markets are experiencing a little bit of whiplash and coming down at this moment in time. Now, this is pretty much the same for US core CPI year over year, previously at 5.7%, and it did come in at 5.6%, a slight drop year over year. However, forecast was telling us we were going to come down to 5.5, and we actually came in at 5.6. Now, in terms of US headline CPI month over month, this is where things really start to get bearish, because previously we were coming in at 0.1% and we're only clocking in at 0.1% because of the revised CPI. If you remember, we made this video 2 days ago. Originally, the December month over month CPI was actually coming in at minus 0.1%. They readjusted the CPI, they re-amended how it's measured, and they found out, hey, it's not coming in at minus 0.1, it's actually coming up to 0.1. So in the past few days or so, markets were saying that, December CPI was at minus 0.1%, and it's actually risen up to 0.5%, a huge increase in the month over month from December to January. And of course, while in general we're seeing, year over year inflation start to come back down, while we've got month over month CPI heading back up at this moment in time, this means that when we do head over to the US CPI index, so we're not looking at this on a year over year, month over month basis. This is an index scale. Of course, there was a ton of inflation that happened in the last year. So when we're looking at CPI year over year, you have to take into account that a lot of people are thinking inflation is dropping. That's not the case. Inflation is dropping relative to what happened in the huge run up of last year. But if we come over to the CPI index, not taking into account a year over year scale, we're actually seeing CPI push up to a new all-time high up at 299.17. So at this moment in time, coming into January, the consumer price inflation is actually the highest it's been in, well, forever. The more we zoom out, you can see the more this is on a parabolic tear to the upside. In the past year or so, you're seeing a huge increase from where we previously resided at 283, almost coming up to 300 at this moment in time. So how is this going to affect Bitcoin? How is this going to affect the equity markets? And how will this affect the bond markets? Well, there's been a lot of whiplash in the equity markets at this moment in time. There's also been a lot of whiplash for Bitcoin. If we do come over to the 1 hour time frame for Bitcoin, you can really see, I actually made a tweet over on this on my Twitter. This literally happens all the time over on CPI. You have a whiplash in both directions before the markets decide which way you want to go down to. You can see the US 2 years decided they want to break down, then they decided they wanted to whiplash back up. You can see the equity markets decided they wanted to break down, then they wanted to have a huge whiplash back to the upside, and since then we've actually had a huge pushback down. So, these whiplashes a lot of the time happen on the day of the CPI, and we're seeing this with Bitcoin right now. Bitcoin is currently rising. Before I started to record this video, it was down about 0.5%, and, really in the past half an hour or so, we've seen a huge whiplash back up to the upside. However, in the higher time frames, we're still sitting in some pretty bearish patterns at this moment in time, and we've really got an important decision to make while we are residing around about this 21,500 level. If you want to learn more about that, I talked about this very in depth in my video 2 days ago, huge week for Bitcoin, where we talked about, the most recent death cross, and we talked about how we respond on, the higher time frames to 21,500 is extremely important. There's a few reasons why, like we said, the death cross has come into play for Bitcoin. If we do clear up these moving averages over here, you can really see, this downtrending line of resistance, we're currently sitting on it right now around about 21,500. So this is a huge week for Bitcoin. We do need to wait a little bit of time and see how we respond to this trend line. In my opinion, it does look like we are forming something quite reminiscent of a bear flag at this moment in time. You could also argue this is a little bit of a W pattern, although I don't like how the wick is starting to slant to the downside for this. If we come over to the daily time frame, you can really see, something like this, in my opinion, is what is playing out for Bitcoin. We are in a nasty bear flag at this moment in time, and if we do zoom out even further, this really looks like a Bart pattern, which is where you have a parabolic run to the upside or the downside, depending on which way you're looking. And, as you come and establish the range highs, you start to put in a spiky top before having a parabolic run all the way back down to the downside. So, of course, like we discussed in the most recent video, huge week for Bitcoin. 2 days ago, we talked about 21,500. You really need to keep your eyes on this price target. But if we do lose this price target all the way over here, the same way that we had a parabolic run back up, there has not been much volume supported with this most recent rally to the upside. So if we do take a line graph, you can basically see as soon as you start losing this range, 21,500, 21,000 really, there's really no volume until we come all the way down to 16,800, maybe even 16,600, and then pretty much from then it looks like we'd be coming back down to new range lows. But I do see a bear flag playing out at this moment in time. I do see a Bart pattern playing out in the higher time frames as well. You can see that we are really just sitting on this trend line deciding what we're going to do. In terms of the EMA ribbons, you can see we haven't quite made it up to the short-term moving average, but it is looking like we're showing a bit of weakness right now. And for the bull market support bands, we're currently just sitting above these. However, no correction, no retrace of these, no bullish impulse from the bull market support bands has been found at this moment in time. So once again, in the immediate short term, 21,500 is really the price target you want to keep your eyes on for the rest of this week. It's only Tuesday, so bear in mind, weekly time frame, monthly time frame, how we respond to 21,500 is super important. If we do draw a swing high Fibonacci from this 25,300 zone all the way down to the swing lows at 15,500, you can actually see, this, once again, we're seeing this same price target, 21,500, coming into confluence with the 618 Fibonacci. So, once again, 21,500 extremely important. I don't necessarily think we're going to have a huge run to the upside. If we do have a little bit more of a push, your 786 Fibonacci, 23,150, also, reenacting with this potential double top playing out. Maybe this could play out as something like an M pattern with a rejection from the 786. This level, these two price targets, 618 and 786 that I just mentioned, are going to be extremely important for Bitcoin. Higher time frames in terms of the oscillators, higher time frame oscillators which take a lot of momentum to move, like the squeeze momentum indicator, are still in light green, indicative that since we found these local bottoms over here, we haven't really switched into a bearish trend, even though we've started to top out from 24,200. So we've got a lot of room to move to the downside if we do break down. Also, the MFI is in agreement with this. You can see the money flow index, which is basically like the RSI, that also takes into account volume in the market, is above the heart line. So I'm currently sitting around about 54, 55, and we are coming into contact with this, macro downtrending line of resistance, which has been in place since just before Bitcoin topped out at its all-time highs. Or more specifically, its first all-time high before coming up and double topping. So, the volume is very overextended in the market right now. You can see that because every time we've come into contact with this again, we normally have a huge move back down to the downside. And the stochastic RSI is a quicker moving oscillator. So I like to look at the squeeze momentum indicator to tell me, hey, this is when a macro trend is going to start moving down. And I like to look at the stochastic RSI to tell me, hey, This could be the start of a new bearish trend, and already since we topped out around about 24,000, the stochastic RSI is flipping bearish on the weekly time frame, and it's still heading down very, very strongly. Also, before we move on to the equity markets, I would like to highlight, as CPI came in today, a lot of people are moving their cryptocurrencies probably onto exchanges, as we are seeing the number of Bitcoin active addresses shoot up about 11% on the daily time frame. Currently 968,000 active addresses. Why this is important is if we do look at Bitcoin in correlation to this, I've mentioned this many times on the channel, so I won't spend too long talking about this, but every single time the active addresses have a spike to the upside, this pretty much always correlates to a move to the upside as well for Bitcoin. But with these spikes in the active addresses, when the active addresses are the most overextended, that is when the most amount of Bitcoin has been moved onto exchanges, and people are often looking to liquidate their cryptocurrency. So a lot of these spikes correlate to local tops in the price action before we break back down to the downside, and we are seeing a very healthy uptrend, not necessarily a linear uptrend, but you can see, really since just before the bull market top, once again, you can see the inverse. When the active addresses are bottomed out, that is often when the price bottoms out. These move pretty much in tandem, and right now we're seeing, higher highs, higher highs, higher highs. So the active addresses keep on pushing up and up and up and up, and when we are seeing this, when the active addresses start to top out and roll back down to the downside, this is probably when we're going to see a move back down to the downside for Bitcoin. Now, moving on to the equity markets before we talk about the bond markets, you can basically see, once again, not ambiguous. As soon as the CPI came out, this was right here. Now, as I discussed earlier on in the video, we did a post on this. We basically had a whiplash to the downside, a huge whiplash to the upside, and then a move further back down for the equity markets. And this is what we're currently seeing at this moment in time. CPI came out round about here. We had a huge breakdown to the downside, a huge wick back up to resistance, which I'll show you in a second, and then a huge move back down to the downside. On the hourly time frame, we're really not looking too good right now. You can see we had this nasty bearish engulfing candle. Right now we're trying to push up a little bit, and this is not looking like a nice doji candle to set us in the mood for the next move to the downside. Over on the daily time frame, if I come over to the 4-hour time frame, I think it's a bit easier to see how I've drawn this. You can see, candle body wicks, candle body wicks, candle body wicks. We more or less kind of held the candle body closes here before establishing candle wicks, candle body close, held a support from candle wicks, candle body closes all the way over here. And since we've broken beneath this trend line on the hourly time frame, when we did have that whiplash back up according to the CPI report, right over here, you can see the equity markets, specifically the E-mini futures for the S&P 500, came back and retested this trend line and are starting to move back down. On the 4-hour time frame, once again, like I said on Twitter, I can't emphasize this enough. This is something that's very, very typical of the CPI days. The markets are often in mass undecision. They can't decide whether they want to break up. They can't decide whether they want to break down. So a lot of the time you have these huge moves to the downside, huge moves back up to the upside. You move back into the heart line, you have a doji candle before the markets really decide what they want to do. And right now we're really in decision time with this doji candle playing out for the equity markets. On the 1-hour time frame, once again, I do think we are going to be getting ready to start breaking back down to the downside. Over on the Heiken Archies, you can see the trend has started to flip back down to the downside. 4-hour time frame, daily time frame, weekly time frame, nothing has yet flipped bearish. I'll keep you up to date on this, but of course hourly time frame for the dojis, it is looking like we are pretty overextended right now, and we should be heading back down to the downside. And also, the fear and greed indexes for the equity markets are super overextended right now. We're actually sitting in 72, almost pushing into extreme greed once again. Now, last week for the equity markets, we started to top out. If I come over to the weekly time frame, you can see last week and the week before that, we were really topping out, and that's when you can see that the equity markets were at 78 in extreme greed. For right now, they're sitting in greed on the cusp of pushing into extreme greed. If we look at, some of the 7 fear and greed indexes, which comprise this chart over here, I'm not going to, run through every single definition of all of these. You can look to the right side of the screen if you want the in-depth definitions. Feel free to pause the video and look at how these are calculated or used. But when we look at the S&P 500 and its 125-day moving average, we're miles above this. We're in greed at this moment in time. Stock price strength is in extreme greed. Stock price breadth is in extreme greed. Put and call options are in extreme greed. Market volatility is in neutral. But with this, I almost say this is in extreme fear for the VIX, which basically means extreme greed. Extreme greed for the markets, because the VIX is beneath its 50-day moving average, and if you didn't know, the VIX moves inversely to the S&P 500, and a lot of the time you can see down here, when the VIX decides to find a bottom, when it's miles beneath the 50-day moving average, it has a huge move back up, and with this, these huge moves back up in the VIX, the volatility index for the S&P 500, often correlates to when the VIX has a move back up, and of course the equity markets head back down. Safe haven demand in extreme greed, and junk bond demand is in fear at this moment in time. So people aren't greedy enough to jump back into junk bonds because these carry a much higher risk. Once again, if you want to learn more about these, feel free to pause the video and just look at how these are calculated and look at, a little bit more of a definition about these. I won't explain them all, but more or less all of these that compromise this fear and greed index are summating to the fear and greed index being at 72 in greed, pushing very, very close to extreme greed. And wrapping up this video on the bond markets, now US government bonds are up at this moment in time, with the US 10-year up about 0.27% on the day, and the US 2-year pushing up to 1.17% on the day. We're also seeing other government bonds, which I won't really discuss in this video, like the Euro bonds, Euro 10-year yields, and also the German 10-year yields are up. So basically government bonds are pushing up on the daily time frame. If you don't know why this is important, if you're new to the channel, warm welcome. Government bonds basically trade inverse to the S&P 500, and also of course your cryptocurrency markets. When government bonds normally decide to find a bottom, this is normally when the S&P 500 and equity markets decide to find a top. When government bonds decide to find a top, consolidate, break down, whatever you want to call it, this is when your S&P 500 finds a bottom and goes back up to the upside. So these are definitely inversely correlated. That is not ambiguous whatsoever. And if we do look at the US government bonds, like we said, on the daily time frame, they're pushing up. If we come over to the 1 hour, you can see when CPI hit, we had a huge move back up. While the equity markets are deciding what they want to do at this moment in time, you can see the 10-year yield is coming a tiny bit down on the 1 hour time frame. But in general, if we come over to the weekly, you can see we are breaking out of this huge bull flag, which has been in place since the 1st of August 2022. And currently, with this move back down that we've had in the past day or so, we've actually come back down and back tested the support, which was, previous resistance, hopefully flipped to support for the US government bonds on the 10-year yields. So if we do manage to hold this as support this week, and we do stay above 3.65% for the 10-year yields, it's very, very likely that we push all the way up to the 1.236 Fibonacci extension, all the way up here at 5.7% for the 10-year yield. Now, while the 10-year yield is pushing up on the daily time frame, the 2-year is exploding much faster. And veterans of the channel will know how this will affect the 10-2. I'll talk about that in just one second. If we come over to the 1 hour time frame for the 2-year yields for the US government bonds, you can see this took a huge run up since the CPI numbers came out. This actually went up about 4.51% since it had this little whiplash to the downside from the CPI numbers that obviously came out. So really right now the 2-year government bonds are absolutely skyrocketing. They've cleared this resistance level, they've cleared this resistance level, they've cleared this resistance level, and they're currently retesting around about this 4.6% level. If we do manage to break above 4.64%, then we're going to push up, break above these previous all-time highs for this cycle, and likely head all the way up to, once again, another Fibonacci extension target that I've got very similar for both of these, because once again, the 2-year government bonds for the US have broken out above broken out of the bull flag target. So I am expecting that we do head up to this target all the way up here. We previously said this was going to be about a 12% increase, but right now we've started to head up a little bit. About another 11% increase is what I think is in place. So because of this, of course, we've got the US government bonds. The 10-year is increasing slightly on the day, but the 2-year is exploding. So what this means for the US 10-2, if you're wondering what this is, we've just looked at the US government bonds 10-year graph, and we've just looked at the US government bonds 2-year graph. All we're doing is getting the summation of the 10-year government bonds and minusing the 2-year government bonds. Now, you might be wondering, why would we be doing this? From a fundamental perspective, I don't have time in this video to explain why economists look at the 10-2. Basically, in a very, very short summary, the 2-year government bond always pivots before the 10-year government bond. So, for example, if the 2-year starts heading up and you're subtracting the 2-year from the 10-year, what you're going to see is the 10-2 start to head back up to the upside, because the 2-year will be ready to pivot back up before the 10-year. And why we look at this is because the US 10-2 moves in direct correlation with the S&P 500. If we really look at, have to zoom out a little bit, you can see once the 10-2 started to break back down to the downside, this is when the S&P 500 also started to break back down. So for this video, I won't explain the fundamental use case. You now know, from a technical perspective, how these two move in tandem. If you want to learn a lot more about the 10-2, feel free to head over to my YouTube channel, click on my educational playlist, and head down to this video, Understanding Market Conditions. I made a 10-minute video talking about everything fundamentally, technically, and how the 10-2 is calculated. So if you want to learn more about that, you know where to go. But from a technical perspective, the 10-2 has just broken down to the downside and made new lows. And as we just explained, this is a leading indicator for Bitcoin. This is a leading indicator for the S&P 500. So, while the Bitcoin and equity markets are still sitting at slightly elevated levels, in the higher time frames, they do definitely follow the 10-2. And while the 10-2 has literally just broken down into new lows today. If we come over to the daily time frame, you can see we had previous range lows established over here. We broke down equity markets, and Bitcoin soon followed. We then established new lows. I fat fingered this a tiny bit, but you can see right here, we established new lows on the 7th of December. Today, we have just broken down into new lows for the 10-2. So what this means for your equity markets and what this means for Bitcoin is they will soon follow the 10-2. After all, government bonds are a leading market indicator. The equity markets tend to follow what's happening in the government bonds and the US dollar. And as we all know, Bitcoin, while it is a great cryptocurrency, this is nothing that is a leading indicator for itself. The Bitcoin and the cryptocurrency markets, more specifically, cryptocurrency markets, altcoins follow Bitcoin. Bitcoin follows the equity markets. The equity markets follow the dollar, financial conditions, and government bonds. And while we're looking at the government bonds exploding up, we're seeing the 10-2 head back down. So adding all these things together, this is showing us that, once again, your equity market should be heading back down very, very soon. And so should Bitcoin. For Bitcoin, really keep your eyes on 21,500. How we respond to this in the next few weeks is very, very imperative. So that's all I've got for you for this video, my friends. Inflation came out hotter than expected. What do you think is going to happen? Let me know down below. As always, if you do enjoy the content, let me know down below by leaving a like and a comment. Share the videos with your friends. And if you do want more of my posts, charts, memes, economic data, all that good stuff, be sure to head over to my Twitter at 618_cowboy. Also, if you want to join the Discord community, be sure to head over to my YouTube page, click on the About section, and you can see my Twitter, Discord, Instagram, and my official merch store are all linked down below. But for today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.